Ever wondered how the Oracle of Omaha, Warren Buffett, suggests you should prepare for retirement? Here's his take. I think it's the same strategy that makes sense practically all the time. Consistently buy an S&P 500 low-cost index fund. Keep buying it through thick and thin. And especially when times are tough, just keep buying. American business is going to do fine over time, so you know the investment universe is going to perform very well. The Dow Jones Industrial Average went from 66 to 11,497 in 1 century. American businesses are bound to succeed. The trick isn't necessarily to pick the right company. It's crucial to be consistent and do it in a very cost-effective manner because costs significantly impact investments. If returns are projected to be around 7 or 8% and you're paying 1% in fees, that can make an enormous difference in what you'll have come retirement. Once upon a time, $1 million was the golden number, the hallmark of true wealth. If you had that million, you'd have been placed amongst the ranks of the wealthy. Today, we picture billionaires in sprawling mansions, cruising in luxury cars, and enjoying high-ranking executive positions. But let's wind back the clock to 40, 50, or 60 years ago, and that picturesque lifestyle was the aspiration for those with a mere million. Yet, in today's economy, $1 million doesn't stretch as far as it once did. Contrary to popular belief, being a millionaire doesn't always equate to vast riches or financial freedom. Sure, it sounds like a hefty sum, but what kind of income can $1 million truly generate? Is it enough for a comfortable retirement? Let's dive deep and uncover the lifestyle you could realistically lead with a net worth of $1 million. If you're interested in improving your financial future, make sure you subscribe to the channel and hit that like button. At a glance, it might seem tempting to simply withdraw and spend the yearly gains from a portfolio during retirement. Let's paint a picture. You have $1 million invested, and in 1 year, it yields a 12% return. That's a handsome $120,000. Sounds like you could just withdraw that and live comfortably for the year, right? And maybe the next year, the portfolio grows by 8%, gifting you $80,000. While this seems straightforward, there is a catch. Stock market returns can be a roller coaster. Take 2018, for instance. The S&P 500 took a dip, ending at a disappointing minus 6%. That's a $60,000 dent in your portfolio, not leaving you much to spend. But then 2019 sees a swing upwards, with the S&P 500 soaring to nearly 29%, marking a jubilant year for investors. This stark variation underscores how unpredictable the market can be. While markets can see periods of growth, there's also the chance of hitting stagnant years. One common misconception is believing it's safe to withdraw all your yearly gains. But this mindset has pitfalls. Firstly, markets fluctuate significantly year to year. Secondly, there's the sneaky factor of inflation that can erode the value of your $1 million nest egg. Let's break it down. If the S&P 500 averages a return of 10% a year, in your first retirement year, you'd draw an income of $100,000, a comfortable amount. But speed up 30 years, that same $1 million, even while generating an average of $100,000 yearly, won't have the purchasing clout it once did. Why? Inflation. At a typical rate of 3%, within 24 years, the buying power of your wealth halves. Opinions vary on the safe withdrawal rate. Some might tell you to stick to withdrawing gains, but as highlighted, this isn't always viable. Some suggest a conservative 3% due to market uncertainties. Others lean towards 5% during prolonged bull markets. Yet many experts champion the 4% rule. This isn't about portfolio returns, but the amount you withdraw. In your first retirement year, you take out 4%, so $40,000. If the cost of living rises 3%, the next year you draw $41,200. Continue this for 30 years, and there's almost no chance of depleting your funds. The 4% rule isn't arbitrary. It's built on a myriad of factors. Firstly, the often cited 4% rule is based on a portfolio split, 50% in stocks and 50% in bonds. This is a rather conservative approach. Notably, Dave Ramsey, a particularly cautious investor, advocates for people to invest 100% of their money in growth stock funds, avoiding bonds altogether. He believes that bonds can be as risky as stocks, with much lower returns. Portfolio composition varies depending on individual preferences. While some opt for a higher exposure to bonds and a reduced stake in stocks, it's generally advised to tweak the balance as you age. The older you get, the higher the bond allocation should be, aiming for stability over high-risk, high-reward scenarios. videos. Secondly, the 4% rule is designed for a 30-year retirement span. So if you're considering early retirement in your 30s or 40s, a 4% withdrawal might be too aggressive, potentially exhausting your funds prematurely. If you're set on a 30-year retirement, this strategy, statistically speaking, gives you an almost certain chance of never outliving your savings. But here's the catch. How many of us can predict the exact length of our lives? While some embrace the live for the moment philosophy, aiming to spend every dime while alive, it's a dicey approach. Not knowing our lifespan underscores the importance of planning cautiously. The Social Security Administration suggests that the average life expectancy for a 65-year-old is just shy of 30 years. Yet, that's merely an average. As an investor, it's prudent to plan for an extended retirement. The last thing you'd want is to barely scrape by or run out of funds. Running out of money in retirement isn't just a hypothetical risk, it's a genuine concern. One should consider factors like personal health, family genetics, and lifestyle to gauge potential lifespan. If you're already 65 or older, your planning might differ from someone younger by 3 decades. Here's an intriguing fact. The average life expectancy has increased by around 5% over the past 30 years. Bearing this in mind, withdrawing 4% might be a bit ambitious if you anticipate a retirement lasting more than 30 years. Social Security benefits aren't uniform. They hinge on factors like your retirement age, contribution duration, and your income over the years. Opt to draw benefits at age 62, and you'll see a smaller monthly sum compared to someone who waits until 65, 67, or even 70. On average, individuals get about $18,000 annually from Social Security. Combine that with a 4% portfolio withdrawal, and you're looking at an annual income of $50,000. For married couples, Social Security payouts could double, potentially taking your combined yearly income to a solid $76,000. When you juxtapose this with the average U.S. household income in 2021, which was approximately $68,000, it puts things in perspective for retirees. The next thing to understand is how taxes vary considerably among individuals. The amount you owe primarily hinges on the type of retirement account you utilize. The most prevalent accounts include traditional IRAs and 401ks. With these, distributions are taxed at regular income rates. On the other hand, with a Roth IRA, you contribute post-tax funds, ensuring that distributions are received tax-free. But many hold a mix of accounts, a brokerage account, 401k, IRA, and Roth IRA, which makes tax computations a tad complex. Other determinants include your state's income tax policy, your filing status, and, crucially, your income bracket. To get a handle on your projected tax liabilities, first, assess the kind of account you hold and your expected tax bracket. Consulting a CPA is always a smart move. For a bit of perspective, a $1 million portfolio, split between 50% stocks and 50% bonds, might yield an income of $40,000 annually. Now, combine that with the average Social Security benefit, $18,000, and you're eyeing an annual pre-tax income of $58,000 for an individual or $76,000 for a couple. This is a broad estimate. Factors like your portfolio's makeup, expected retirement duration, and various other elements play pivotal roles. Remember, it's imprudent to withdraw all portfolio gains. Inflation will inevitably diminish the real value of your $1 million over time. As you tread the retirement planning path, it's wise to be conservative, especially given the uncertainties of the financial landscape. Don't forget to like, share, and subscribe if you found this video helpful, and stay tuned for more enlightening content. Thank you for joining us on this journey towards financial literacy and empowerment. To learn more about personal finance and investing, watch more videos from our channel.